Welcome to the Deep Dive. We're here to cut through the noise and give you the essentials from the sources that matter. Today, we're digging into the second quarter 2025 earnings call for Toast Inc. That's ticker TOST. The call wrapped up after market close on Tuesday, August 5th. And this one was definitely highly anticipated, especially, given Toast's recent strong run and some of their big strategic moves.
That's right. And for listeners like you, experienced investors, we're going straight to the core stuff. We'll unpack the key financials, what management strategy really means, and crucially, how the market actually took these numbers. Because that reaction was, well, interesting. It's all about figuring out what this signals for Toast's future.
Okay, let's jump right into those headline numbers then. Because, on paper, Toast really delivered a strong quarter. They beat consensus pretty much everywhere you look.
Right.
GAAP diluted EPS came in at 13 cents. Consensus was 11 cents, so that's what, an 18% beat? Pretty solid?
Yep, solid beat there. And non-GAAP EPS also topped expectations, 24 cents versus the $1.23 expected.
No.
And then look at the top line. Revenue hit $1.55 billion. That's a nice 25% jump year over year. And it beat the consensus of $1.53 billion by about $20 million.
Right.
But, for Toast, gross payment volume, the GPV, that's key, grew 23% year over year to almost $50 billion.
Almost 50 billion, wow.
Yeah, and annual recurring revenue, ARR, that SaaS metric everyone watches, jumped an impressive 31% to $1.9 billion.
Yeah. That
really shows the software side scaling up.
And profitability, this felt like a big part of the story this time. Adjusted EBITDA reached $161 million. That's a 10.4% margin, and it soared 75% compared to last year. 75%.
Mm-hmm. Huge leap.
Free cash flow looks strong too, $208 million.
Exactly. That 75% EBITDA growth, that's the kind of thing investors were looking for, right?
Yeah.
It signals maybe a shift towards more mature operating leverage, not just growth at all costs.
Right, moving beyond that cash burn phase.
Precisely. But here's the interesting bit. Despite all these strong beats, the initial market reaction in after hours, a bit. Shares slipped slightly. Yeah, it points to this kind of good, not great feeling. Like execution was solid, no doubt.
Right.
But maybe the market had already priced in a lot of this profitability improvement. And now the focus is really shifting hard towards, the valuation. Is it justified?
Okay, that is interesting. Stellar numbers, muted reaction. We definitely need to unpack that. But first, let's dive deeper into the numbers and what management actually said. Beyond the headlines, it sounds like they really hammered home their execution on those 4 key priorities for the year.
Absolutely. That was the core narrative. Priority 1, scaling locations. Still going strong. They added a record 8,500 net new restaurant locations just in Q2.
8,500 in one quarter.
Yeah, record number. Brings their total to around 148,000 locations.
Yeah.
It shows that momentum in their core U.S. restaurant business is still there, even though they already have over 30% penetration in their top 10 markets. Management kept talking about their flywheel strategy working. Happy customers lead to more customers. It becomes sort of this self-reinforcing thing, making customer acquisition more efficient for them compared to maybe some competitors.
Right, that network effect kicking in. Okay, so the core SMB market is still firing. What about priority 2? Expanding beyond that core, they talked about progress in new segments, enterprise, international, food and beverage retail.
Big progress there. Those segments combined, they crossed 10,000 live sites now. And they're on track to hit over $100 million in ARR from these new areas by the end of the year.
$100 million ARR from the new segments.
Yeah. And get this. It took them 6 years to hit that milestone in their original core restaurant business. So doing it maybe a year or so in these new segments, that's rapid validation.
That's incredibly fast scaling, yeah.
And they highlighted some key wins, like Firehouse Subs. That's a 1,300 location enterprise QSR chain.
Okay, big name.
Shows they can handle large scale. And then Zabar's, an iconic New York grocer. That proves the platform works in high volume retail, handling, tens of thousands of SKUs, lots of transactions, very different from a small cafe.
Right, different operational needs entirely.
And internationally, they officially launched in Australia. That's market number 4 now after the UK, Ireland, and Canada. They said they're leveraging what they learned in those markets to roll out faster in APAC. Smart expansion.
Okay, so broadening the base and doing it quickly. What about priority 3? Platform, data, AI. That always gets attention.
Yeah, and they had news there too. The launch of the new Toast Go 3 handheld device.
Ah, the little ordering tablet thing.
Exactly. But this one's upgraded. Lighter, faster, more durable, 24-hour battery. And critically, it combines their AI engine, Toast IQ, with built-in cellular connectivity.
Cellular, so it works even if the restaurant Wi-Fi is spotty.
Bingo. game changer, according to one restaurant they quoted. Allows payments anywhere, basically. Pop-ups, patios, wherever. Plus, the AI integration, TOST IQ, means staff get real-time info on guests' recommendations right there on the device.
Trying to boost check sizes, I guess.
That's the goal. Personalized service, smarter upselling. They also mentioned positive feedback on Sous Chef, their AI assistant for managers.
Yeah.
Sounds like that's heading for general release later this year, making data insights accessible. Yeah.
Democratizing analytics for the little guy. Okay.
Yeah.
And related to data and growth, that American Express partnership sounded pretty significant.
Oh, absolutely. That's a big deal. They're linking Amex's Resy and Tock reservation platforms with Toast venues, all feeding into Toast Local, which is Toast's own mobile app.
So bringing diners directly into the Toast world.
Exactly. The idea is to funnel millions of diners, Amex card members, Resy users into the Toast ecosystem. That should boost payment volume, obviously, but also their high-margin marketing tools for restaurants. And it opens the door for really personalized experiences for Amex members when they dine at a Toast restaurant, using that integrated data.
So Toast becomes more than just the POS system. It's connecting the diner and the restaurant.
Precisely. It deepens their moat, makes the platform stickier, and creates new revenue streams. Very strategic move.
Okay, that covers a lot of the growth initiatives. What about the final priority? Disciplined investment and margin expansion.
Right, the bottom line stuff. And their updated guidance reflects that focus.
Yeah.
They've actually hit their medium-term margin targets ahead of schedule, which is always a good sign.
Ahead of schedule. Nice.
Yeah. So for Q3, they're guiding non-GAAP subscription and fintech gross profit to $465 to $475 million. Adjusted EBITDA, $140 to $150 million. And for the full year 2025, they raised guidance. Gross profit now expected $1.815 to $1.835 billion. And adjusted EBITDA, $565 to $585 million. That implies around a 32% margin for the year.
32%. That's up significantly from last year, right?
Yeah, up 5 percentage points from 2024. Shows that scalability kicking in.
But wait, didn't you say Q3 EBITDA might be down slightly from Q2?
Good catch. Yes, sequentially down is the expectation for Q3 EBITDA, and Q4 margins are usually a bit lower too. Management explained this. They're actually increasing investments in the second half of the year.
Ah, investing more.
Yeah, doubling down on those growth areas, core market, new segments, international. Plus, some higher tariff expenses hit in the second half. They also noted the first half benefited from some timing on ARR conversion that normalizes now. So it signals confidence, really. They feel strong enough to invest more now to accelerate that long-term growth.
Investing from a position of strength. Okay. So, bringing it all together, record location ads, rapid growth in new markets, new AI tech, Amex partnership, raised full-year guidance, margin expansion ahead of schedule. It sounds like a fantastic quarter operationally.
It really does.
Which brings us back to that puzzle. Why the lukewarm market reaction? Why didn't the stock pop?
Yeah, it really boils down to valuation and expectations. You have to remember the context. Toast stock had already had a massive run, up 31% year-to-date before the call, at 67% over the past year.
Way ahead of the S&P 500 then.
Way ahead. And things like that Amex deal announcement back in July, that had already boosted the stock and analyst price targets. Jefferies was already at $54.
So expectations were sky high.
Exactly. The buy-side chatter seemed to be, okay, solid beat, good execution, but the guidance raise was basically just in line with where elevated expectations already were. It wasn't a massive blowout guide that would justify another big jump from current levels.
Ah, okay.
So you saw some investors maybe trimming positions, thinking the valuation at, say, 10 times 2025 estimated EV to gross profit felt a bit rich without a bigger upside surprise on the outlook.
The classic price for perfection scenario.
Pretty much. The market had already rewarded them for the expected profitability gains. Now it's scrutinizing, okay, how sustainable is this growth? Especially with, U.S. restaurant traffic kind of normalizing, and GPV per location actually dipped slightly year over year.
Small dip, but maybe a sign growth per existing customer isn't accelerating.
Could be something to watch. So the narrative continues to be this pivot, right? From POS vendor to a full end-to-end restaurant operating system, monetizing payments, data, AI, scheduling, all of it. Management sounds confident, especially about those new segments becoming really meaningful. If they keep executing like this, that path to mid-teens EBITDA margins and global scale looks achievable.
But it's that tension, strong performance versus a high valuation.
Exactly. That's the core investment debate for Toast right now.
So looking ahead, maybe towards Q4 and beyond, what are the key things you'd tell listeners to keep an eye on? Catalysts or risks?
Okay, catalysts. Definitely watch how that Amex partnership rolls out. Do we see real volume coming through those guest discovery APIs? Second, early data on the Toast Go 3. Is it actually leading to higher check sizes, better upsells, proof points needed there, and of course, holiday season GPV trends? How's consumer spending holding up in restaurants?
And the risks.
Well, one is that take rate. How much is Toast extracting from each transaction and subscription? If that creeps up too much, could it cause churn, especially among smaller restaurants?
Pricing power has limits.
It does. And competition isn't standing still. You got
Yeah.
Square, Lightspeed, Fourth, lots of players pushing AI and integrated solutions too. It's a tough market.
Got it. A dynamic space, for sure. Okay, let's shift gears. It's time for our This Is Not Financial Advice segment, where we float an outrageous, maybe, but potentially plausible trade idea based on what we've just discussed. What have you got for us today?
All right. So given Toast's strong execution, that clear strategic direction, but also the market's sort of valuation hesitancy.
Yeah.
Here's a thought. How about a pair trade? Long Toast, TOFT, and short Lightspeed, LSPD.
Ooh, interesting. Long Toast, short Lightspeed. Walk us through the thinking there.
Okay, the rationale is basically betting on Toast's demonstrated momentum and differentiation, especially upmarket. Those wins like Firehouse Subs, Zabars, they show the platform scaling effectively into higher value segments. Plus, the Amex deal really strengthens their ecosystem play, driving diner traffic and data integration. They seem to be building a more complete operating system.
Right, focusing on that end-to-end platform advantage.
Exactly. Now, Lightspeed, they're a solid company, also pushing AI, operates more broadly across retail and hospitality, perhaps. But the bet here is that Toast, within its specific focus on restaurants and related food beverage retail, is showing superior traction in integrated services and ARPU expansion, especially in these newer, higher value segments.
So you're not necessarily saying Lightspeed is bad, just that Toast might be executing better within this specific competitive dynamic.
Kind of. It's a relative value play. Betting that Toast's focus strategy, product depth, and go-to-market in restaurants will lead to continued market share gains and better performance relative to Lightspeed, even acknowledging Toast's higher multiple. You're long the company you think has the stronger strategic position and execution momentum, short the peer that might face more relative headwinds in achieving similar integration and ARPU growth in that specific vertical.
It leans right into that idea of Toast successfully becoming more than just POS. Audacious, but I see the logic.
It's a bet on strategic execution winning out. But again, absolutely just for discussion, not financial advice. Please do your own research.
Understood loud and clear. Okay, that brings us near the end of our deep dive into Toast's Q2 2025 earnings call materials. We saw a quarter with, frankly, really strong financial beats, impressive location growth, and some genuinely exciting developments on the product and partnership fronts.
Yeah, a lot pointing towards a robust strategy. But as we discussed, the market reaction really highlighted that valuation matters. A lot. Execution is strong, but the bar was already set very high, and maybe future growth acceleration is now the key focus for investors.
So as you digest all this, what's the one big takeaway that stands out for you? We hope thinking through this helps shape your own view on the restaurant tech space.
For me, it's that successful transition from a point solution to a true platform. Toast seems further along that path than many perceived, but the market needs continued proof to justify the premium. And remember, everything we discussed today is purely for informational purposes. It should definitely not be taken as financial advice.
Couldn't agree more. Thank you for tuning in to the deep dive. We'll be back soon with our analysis of another key market event.